Hello and welcome to Mission Wealth's Market Perspectives for the first quarter of 2015. Matthew Adams here, joined by Kieran Osborne, Portfolio Manager. And really, as we normally do, we start off with some key themes. We'll try to keep the first slide consistent with the top themes that we're hearing for the first 5 minutes, and then go into deeper detail later. But really, one of the top themes that we hear is that oil prices have dropped 50%. How is this going to affect my portfolio? So we'll dive into that a bit. We'll also talk about the stock and bond markets, look at what areas of the equity markets look most attractive to us, and also take a look at our interest rate forecasts. Finally, the themes for 2015 really remain extensions of 2014. Continued strength in the U.S. dollar. We see falling unemployment still. However, we just don't see wage growth yet, and as a result of falling energy prices and stagnant wage growth, really kind of a low inflation environment. Divergent monetary policy continues with the European Central Bank and the Bank of Japan being more aggressive, while at home, the Federal Reserve is getting more conservative with respect to monetary policy. We thought we'd start off first and say, we really are long-term investors. We believe in diversification. We believe in asset allocation. And we do believe there is a benefit to a global approach. We seek steady returns here at Mission Wealth with moderate risk levels, and we are really customizing each of the portfolios to match our clients' specific financial plans. We've shown this patchwork diagram to our clients many times, but it really highlights that asset classes tend to be in favor for a period of time and then move out of favor as relative valuations get expensive, and vice versa. So, diving into this theme a little bit further, we asked Kieran to take a look at the global equity markets, and we'd like to share some of those results with you now.
Thanks, Matt. Our findings show that international stocks and US stocks have historically had very similar annual returns. And interestingly, half the time international stocks outperform US stocks, and the other half the time US stocks outperform international stocks. This makes sense, given the different economic cycles and environments different countries find themselves in at various points in time, which in turn impacts stock prices differently around the world. Now when you look at emerging markets, what's really interesting is that they have historically outperformed US stocks the majority of the time, but they are more volatile. So you get increased expected returns commensurate with the increased risk. Now consider the recent outperformance of US stocks. Statistically speaking, we may be due for international and emerging market outperformance. Furthermore, we believe there are many positive economic dynamics that may underpin strength abroad, which we will discuss in further detail. This following slide outlines global economic and market forecasts. We work with a number of research partners who provide us these forecasts. Obviously, they are forecasts and nothing is guaranteed. That said, expectations are for an acceleration in global growth in 2015 and 2016, with world GDP growth expected to be a little over 3.5% in 2015 and nearly 4% in 2016. Turning to equities, expectations are for mid-single-digit returns in the US, while international and emerging markets are expected to post much higher rates of return over the next 12 months. There appears to be upward pressure on interest rates, particularly with the Fed likely to tighten sometime in the latter half of this year, with the 10-year Treasury yield forecast to be closer to 3% by the end of the year from its current yield of just under 2%. The dollar is also forecast to continue to strengthen against most major trading partners, particularly as we experience diverging monetary policy around the world. For this reason, we have recently added a currency hedged position for international equities, which we will discuss in further detail. Lastly, expectations are for a bounce back in the price of oil from the current sub-$50 price range we find ourselves in. Speaking of oil, we have fielded many client questions regarding the recent precipitous fall in the oil price. Simply put, the underlying supply-demand dynamics don't appear to warrant the dramatic sell-off we have seen. Expected oversupply in 2015 is in line with historic norms and actually less than 2014. And the increased US production story is nothing new. It was well known when oil was trading at $110 in June and $90 in September. Rather, we believe the price drop may be due to investor speculation and the increased volatility in the latter half of last year, which may have caused many leveraged positions to exit the oil market. That said, dropping oil prices can be seen as a positive for many economies globally, as it is essentially a tax cut for the consumer. Those countries that stand to benefit the most are the ones that import more oil than they export. As the graph to the right shows, the recent drop in oil is likely to benefit many international and emerging market economies, whereas the US is likely to experience a smaller net benefit. Talking about the economy, I'll hand it back to Matt, who has some interesting points to discuss on jobs and inflation.
Thanks, Kieran. You know, one of the things the Federal Reserve is going to be watching is inflation. And although the drop in energy prices will lead to a transitory effect on headline CPI, where we're going to see, you know, inflation maybe drop to 0%, you know, it really is likely going to be something that's going to reverse itself in the latter half of 2015. And then we'll see, as energy prices increase, inflation increase as well. However, you know, when we speak about inflation, although we've seen, you know, great improvement in the unemployment rate from a near, you know, 10% unemployment rate in 2009 to a place where we're, you know, in the mid-5s here in 2015, what we have not seen is a corresponding increase in wage growth or wage pressure. You know, we really do feel there is a great deal of underemployed in the workforce right now, with those that would prefer to work more but simply don't yet have the opportunity. So do expect some volatility within the inflation figures, and it may very well be a factor that allows the Federal Reserve to remain a bit more accommodative for longer. We do, however, expect interest rates to begin to move upward, and the Fed has communicated that the liftoff date to be somewhere in and around June of 2015. If we do see some weak inflation numbers, then I would not be surprised to see the Federal Reserve push that date back, but we are thinking the second half of 2015 as the point in time at which the Federal Reserve relaxes its zero interest rate policy. Turning abroad, the Bank of Japan and the European Central Bank are two other very big players. We see the Bank of Japan as continuing its highly aggressive monetary easing policies. And a little bit later this month, the European Central Bank is set to give more direction as to whether or not they're going to be engaging in more sovereign bond purchases. So that's a highly anticipated announcement in the latter half here of January 2015, and we'll be sure to keep an eye on that. You know, one of the outcomes of all of this central bank divergent behavior is that we've seen currencies really be quite volatile. The U.S. dollar is at a near 11-year high as a result of the Federal Reserve becoming more tight, and the European Central Bank and Bank of Japan just being very loose with their monetary policies. So, you know, that's something that has affected the markets quite a bit, the global equity markets. And so, you know, as we take a look at the global equity markets, I'd like to turn it back to Kieran to give us an update.
Thanks, Matt. The more subdued outlook for U.S. equities is partially due to valuations, with the S&P 500 currently trading at a 16.2 PE multiple versus the historic average of 15.6 times. That said, the low interest rate environment that we find ourselves in may provide a tailwind for equities when considering the alternative being a sub 2% yield on 10-year treasuries. This following chart just reiterates this view. If earnings grow 10% and valuations stay between 15 and 16 times on a PE multiple, the math tells us that we should expect mid-single-digit returns for US stocks. Turning to international markets, 2014 was interesting. In local currency, international markets did relatively well. But when converting to US dollars, because of the US dollar strength, many returns were negative. With the outlook for the continued strength in the US dollar, we believe adding a currency hedge component to international equities makes a lot of sense, and why we actively did this for clients in 2014. Looking at developed market valuations around the world, the US is clearly the most expensive. whereas international markets are trading at a PE multiple of around 14 times and offer some compelling dividend yields. Emerging market valuations are even more attractive, offering a PE multiple of 11 times and many attractive dividend yields. Do note though, and as we outlined earlier, emerging market stocks have been more volatile, but they have also outperformed US stocks historically. So with all that said, I'll turn it back to Matt, who will discuss some of the steps that we've been taking recently.
Okay, great. With that low interest rate environment around the world, we continue to prefer a greater tilt towards global equities. We see many positive economic factors as well as monetary factors benefiting the equity markets in 2015. The dollar continues to be something that we talk about with our clients. We continue to forecast strength there. And as we've alluded to several times, we initiated a currency hedged investment in the fourth quarter of 2014 to help sidestep some of that dollar anticipated strength. Similarly, due to that U.S. dollar, we've eliminated our commodity allocation. We've reallocated those proceeds into master limited partnerships, which provide a 5% dividend yield, growth potential, and also have an inflation pass-through component, which will help if and when inflation gets going in the future. Socially responsible tilts, those are available now at Mission Wealth. We can really customize those to each of our clients' needs. And we do have an awareness that this has been really a solid 5-year run plus going here in the global equity markets. We talk about valuations, but we're really continuing our search within the alternative asset class, constantly looking for innovation. So with that, we'd really like to take the chance to thank you. If you have questions, please don't hesitate to call your client advisor. And as always, we appreciate your time. Thank you.